how institutions hunt your stop losses, and how you can avoid getting trapped.
All right, let's jump right into this. You know that universal, absolute gut punch of a feeling? You set your stop loss at what looks like the perfect, totally safe level, only to watch the market drop, clip your stop by just a handful of pips, and then, almost instantly, reverse and absolutely rocket in your original direction. It's incredibly frustrating, right? It honestly makes you feel like the market is actively out to get you. Well, welcome to the Explainer. Today we're going to decode the exact mechanics behind why that happens, and more importantly, how you can actually see it coming.
That brutal sequence of getting stopped out just before a massive move, that is the sheer pain of the false breakout. And I need you to understand something right out of the gate. This isn't just random market noise. It is absolutely not bad luck. It's a highly systematic trap. This is exactly how institutions hunt your stop losses to fuel their own massive positions. I mean, they need liquidity, and honestly, retail panic provides it perfectly.
So consider this an elite, high-tech academy lesson. We are officially on day 10 of the Time and Cycle Mastery 60-day series, and today we're taking a really massive leap forward. We aren't just looking at basic trends anymore. We are going to decode the specific mathematical structure behind this institutional manipulation using Elliott wave theory. By the time we wrap up this explainer, you are going to view the market matrix entirely differently.
Section 1. Elliott wave corrective patterns. The pauses between the impulses.
Now, to really understand this trap, we actually have to look away from the primary trend for a minute. We have to look at the pauses. In Elliott wave theory, market movements are divided into two main categories, right? You've got the impulse waves that drive the trend and the corrective waves that pause it. And here's the thing, the stop hunts don't happen during those clear soaring impulses. They happen in the messy, confusing pauses. While impulse waves move the market forward in 5 clear steps, corrective waves, the pullbacks, typically unfold in a distinct 3-step structure. We label these as wave A, wave B, and wave C. This ABC pattern is the foundational mechanic of literally every market pause.
Take a look at this. This is your classic ABC corrective structure. You can clearly see a strong move up, followed by that jagged 3-wave pullback, A down, B up, C down, before the primary trend resumes. This is your basic zigzag, or regular flat. It's clean, it's predictable, and honestly, it's mostly harmless. But the institutions, they don't use this clean version to trap you. They use a mutated version.
Which brings us to Section 2, Anatomy of an Expanded Flat, the 3-3-5 trap structure. Okay, so we're entering the territory of the flat correction family. Unlike a sharp zigzag, flats move sideways and follow a very specific internal subdivision. It's a 3-3-5 structure. That means wave A is made of 3 smaller waves, wave B is 3 smaller waves, and wave C is 5 smaller waves. And the absolute most dangerous member of this family is the expanded flat. On the left here, we have a regular flat. Wave B politely stops right near the start of wave A. It's totally contained. Now look over at the expanded flat on the right. Notice how wave B aggressively moves beyond the starting point of wave A. It actually breaks the previous higher low. And then wave C swings back and extends significantly beyond the end of wave A. It breaks the boundaries on both sides. This right here, this is the anatomical footprint of a trap. Now you might be sitting there thinking, well, that sounds like a crazy anomaly. It's really not. Look at this quote straight from the source data. Expanded flats are more common than regular flats. Just let that sink in for a second. The trap pattern is the norm, it's not the exception. And it frequently appears exactly when a trend feels incredibly strong, which catches maximum participants completely off guard.
Section 3. The wave B sucker trap. Enticing the wrong direction.
So how does this actually play out in real time? Let's break down the psychology of the waves. It essentially starts with a setup and ends with a sucker punch. Wave A sets the stage by initiating the pause, but it's wave B that really springs the trap. Wave B is literally designed to entice people in the wrong direction. Let's walk through the 3 psychological phases. Step 1. Wave A happens and the public thinks, oh hey, just a standard correction, time to buy the dip. Step 2. Wave B pushes the price to a new extreme. This is the false breakout. The public screams breakout and they all pile in. Step 3. Wave C violently reverses, hunting the stops of everyone who just bought the breakout and everyone who had their stops safely tucked behind Wave A.
Really focus heavily on Wave B here. See how it pushes past the start of Wave A? This is the exact moment the trap is triggered. It performs the very specific task of enticing the suckers to jump into the market. This is exactly where your classic bear or bull traps happen. And listen, here's a massive pro tip from the data. As a general rule, these deceptive B waves tend to happen on noticeably lower volume. The smart money isn't pushing it, they're just stepping back and letting the retail traders run right off a cliff.
Section 4, Wave C, breaking the illusion and hunting the stops.
So, once the retail money is fully trapped in Wave B, the smart money drops the hammer. We're shifting focus now to the devastating final leg, Wave C. Wave C exists purely to break the illusions created by Waves A and B. This is the execution phase of the institutional stop hunt. The crucial point here is how Wave C behaves. Remember that 3-3-5 structure? Wave C subdivides into 5 distinct subwaves. Why does that matter? Because 5-wave moves look like a brand new, incredibly powerful trend. It completely fools investors into thinking a massive reversal is underway. It extends significantly past Wave A, triggering an absolute cascade of stop losses. Broad participation kicks in, but at this point it's entirely driven by pure, unadulterated fear. But hey, here is where we turn the tables. How do we know where this terrifying Wave C is actually going to end? Mathematics. In an elongated flat, there is a very specific Fibonacci rule. Wave C must be a minimum of 138.2% of the length of Wave B, and often it'll reach 161.8%. That number you're seeing isn't random. It is your target. When the rest of the market is absolutely panicking, you're calmly calculating 138.2% from the Wave B high, knowing exactly where the stop hunt will likely exhaust itself.
Section 5. Avoiding common analysis mistakes. Trading with precision.
Now that you can identify the structure of the trap and literally calculate its target, we need to transition from just observing to triumphant execution. Because knowledge is only power if you don't sabotage yourself in the heat of the moment, right? The sources outline the most frequent errors retail traders make. Misidentifying a 3-wave correction for a 5-wave impulse, that's the quickest way to blow up your account. Another huge pitfall is ignoring those Fibonacci relationships. Traders get so caught up in the direction of the trend that they completely ignore the key retracement and extension levels that predict exactly where Wave C is going to reverse. And of course, making emotional decisions when Wave C is plunging.
Which brings us to the ultimate solution. You must always combine your wave counts with Fibonacci levels. Elliott wave theory isn't just flexible guessing, it is strict, rule-based analysis. When you see a 3-wave move for A, a false breakout for B, and a 5-wave plunge for C hitting exactly 138.2%, you aren't feeling fear. You are identifying a high probability reversal zone. This is exactly how you shift from being the hunted to being the hunter.
And that brings us to the end of day 10 and a final thought for you to carry into your very next trading session. Look, every time the market pauses, a new narrative gets spun. The false breakout is going to tempt you. The violent pullback is going to terrify you. But now you see the matrix. You see the 3-3-5 expanded flat for what it is. So the only question left to ask yourself when the market starts moving sideways is this: are you setting the trap or stepping into it? Take this intelligence, apply it directly to your charts, and I will see you in the next lesson.